Good afternoon. Welcome to 25 Minutes with Cap, where each month we discuss recent trends in the specialty insurance space. Today, I'm excited to have Ken Brandt joining us. Ken's the Chairman, President, and CEO of TransRe. Ken joined TransRe in 2006, prior to which he worked at GE and lived different places, not only here in the US, but Europe and Asia. Ken, thank you for joining us.
Great. Nice to see you, Adam.
Yeah, good to see you too. As we go on from here, if you have questions through the session, feel free to enter them into the chat and we'll do our best to answer them. And just a reminder, the content of this webinar is the property of CapSpecialty and is for informational purposes only. You're not permitted to republish, share, or quote from this webinar without the prior written consent of CapSpecialty, which can be obtained by contacting marketing@capspecialty.com. All right, let's get into it. So, Ken, we'd like to ask this question of a bunch of the guests. How'd you get into the insurance business?
Well, probably like a bunch of your guests, it wasn't planned. I didn't know anyone in the industry, didn't have any family in the industry. I graduated from college with a math degree. And back then, 100 years ago, there wasn't a Facebook or a Google or high-tech industry. So basically had kind of like three career choices or three opportunities to get a job out of college. One was academia.
Sure.
One was, interestingly, the government, the federal government, the CIA was a big hire of math majors. And the third was the actuarial science, obviously. And during college, I had passed a couple of actuary exams. And the only thing that proved to me was I was probably not going to have a career being an actuary. So I got a job at Hartford Insurance Group. Back then they had a big training curriculum, and they hired a bunch of kids out of college like me, and they put you up in condos. And so you'd be with 10 or 15 people in a big office, and mine was in Los Angeles, and they train you for up to a year in that office in underwriting. And so that's how I started. And I don't know how well they did training me as an underwriter, but I met my wife there. So we've been married for over 30 years. So that worked out. I'm indebted to Hartford for that, at least. And
then how'd you get into reinsurance?
Well, that was kind of, it was planned and unplanned. Things were happening at Hartford. Hartford was a pretty tough place to work back then, pretty political. Me and my wife, who was also working there, had grown disillusioned with it. So we were looking to leave. And it was shortly after the LA riots. And so my wife is from Texas. She definitely wanted to leave. And so all right, we'll look for a job either in Texas, where she's from, or San Francisco Bay Area, where I'm from. And we ended up finding positions in San Francisco. So I landed at Employers Re, who was owned by GE, and my wife at the time worked for Atlantic Mutual. So we kind of stumbled into the reinsurance part of it.
Is it tricky moving from the actuarial side into the production-oriented side as you went along?
Well, I was never in the actuarial side. So I got my math degree, but right. I went right into underwriting. So right. The actuaries would not accept me. I was not a good enough mathematician to make it as an actuary, for sure. So I never had to make that transition.
So hey, an industry question. So you and I have talked about cyber at different points, and new numbers around 1 in 50 and 1 in 200 events, or 1 in 50s between 5.5 to 24.5 billion.
Yeah.
How much stock do you put in those estimates?
Well, we don't. Not because we're derisive of the modeling companies. I think the
Sure.
models and the modeling companies are getting better by the day, but we don't really manage our exposures by PML estimates on cyber. I think there's likely sufficient data from a frequency standpoint where the models are probably getting pretty good from that standpoint. But in terms of severity, which is what you're talking about, the 1 in 50, 1 in 200, sure. I don't know. It seems to me a mathematical stab in the dark. So we manage our exposures on cyber at TransRe by tracking our notional limits as best as we can.
Sure.
And now we have an advantage over primary carriers in that most of our, like 90% of our treaties have loss ratio caps. So you can actually measure your notional limits to a fair degree of accuracy. So a little bit of advantage over primary insurance companies, but we respect the modelers, we respect the work, but don't put a lot of credibility into those estimates.
Do you think obviously in the property business, you're also counting aggregates. Is the pricing within cyber starting to get to assuming that you're getting properly paid in property, which is probably a question a couple from here. Do you feel like you're now getting into the right arena in terms of being paid properly for the cyber exposures?
For most of the cyber exposures, I would say yes. So, as you know, over the last couple of years, the cyber rates have gone up tremendously.
Sure.
And at the same time, the ransomware up until recently has dropped off a cliff. So that's a pretty healthy 24 months to go through where you feel like you're getting paid for the risk you're taking. But I would say you're getting paid for the attritional risk. You're getting paid for the single occurrence hack,
right?
Even a larger hack. But I doubt the industry is getting paid for systemic risk. I mean, it's very hard to get paid for that. So that's more of a coverage issue, in our opinion. So companies like Chubb and Beasley are trying to address those issues in their forms, which we agree with.
But you don't think it's baked in, really?
The pricing for systemic?
Yeah, the cat exposure.
Well, cat, it just depends on how you want to define a cat, right? So you can have a cat that's not systemic, right?
Sure.
And,
sure.
So I think you're getting pricing for the attritional right now. I think you're getting pricing to fund for some cat, but not a big systemic event.
Sure. We touched a tiny bit on the property business. With the property reinsurance so tight, are you surprised there haven't been many new reinsurers?
Yeah, I mean, so the model to take advantage, quote unquote, of hard markets for reinsurance has changed years ago. So the old model was post Andrew, post Katrina. You'd have all these new insurance companies, reinsurance companies form, mainly in Bermuda, but other places as well. But with the evolution of third-party capital, sidecars, cat bonds, ILS funds, and the like, outside capital can form or be introduced into our industry without the need to form new insurance companies, which is, that's been going on for a decade now. Now, it's true that the flow of that type of capital into the cat reinsurance market has slowed in the last year. And the cause of that is pretty obvious. The results have been horrific over the last 5 years for property cat. So if you were supporting property cat reinsurance, whether as a reinsurer like TransRe or a third-party capital provider, you likely lost money in most of the last 5 years, if maybe even all the 5 years. And we were no exception. We lost money 4 out of the last 5 years in property cat.
Right.
So, it was the increased frequency of low attaching cat events. It was the increased frequency and severity of non-modeled cat events. So you have everything from flood and hail to ice storms in Texas, if you remember,
Sure.
Hail in France, wildfires in California, COVID. All these things are generally non-modeled. And so all that came to be a really significant issue over the last 5 years. So you don't blame capital providers to say kind of enough is enough. I'm going to stand on the sidelines here and see if this market can correct itself. And that's what's been going on over the last year. The market's finally responded. Attachment points have gone way up, terms have tightened, rates have gone up significantly. And so that's the market you're experiencing in property cat right now.
And so when you have so many non-modeled events, I guess you're wondering what the next non-modeled event is.
It's like alternative. Remember, they used to call it alternative rock or alternative music, and it became more the main than rock. So it's like non-model events are more common than model events. It feels like. So the whole industry is geared, or at least it was geared around modeled events. And so when you had a big event and it wasn't something that you planned for, like COVID, or modeled correctly or accurately, like wildfire, you weren't getting paid for these exposures. And so that's the difference that have been made.
Do you think you're getting paid? Are you getting paid for them now?
I think in the last 12 months, I feel really good about where the market is, because it's not just the rates. Rates kind of go up and down, but the terms, the attachment points generally stick. One of the biggest issues from my perspective, or my opinion, was you'd have these very large insurance companies. I'm not talking about mutual insurance companies or smaller boutique firms, very large insurance companies, and their cap programs they'd attach at a hubcap, right? They'd attach really low. So it wasn't really cap protection, it was earnings protection. And, listen, they didn't put a gun to our head. Everyone dove into that and lost a lot of money over the last 4 or 5 years. So the attachment points have all generally moved up. I think those will be more long lasting. A lot of the terms got loose over the last decade. Those all firmed up. I think that will be more resilient. And then the rates will go up and down according to supply and demand.
Sure. Along these lines, how do you balance staying commercial in a particular market versus profitability?
Yeah, that's a great question, because you can't just take it black and white, right? We'll decline everything that doesn't meet our threshold and write everything that does. Relationships are really important in your industry and in our part of the industry.
Sure.
We do make commercial decisions for certain customers in certain regions, but I would define commercial as not knowingly writing something that is going to lose money, but writing something that you have a chance for a profit, but you're not getting anywhere near the terms that you would hope.
Sure.
And we've done that, but the core of your relationship with any insurance company as a reinsurer has to be based upon profitable underwriting. You can't build a global portfolio of reinsurance business on the back of a bunch of commercial favors.
Sure.
So you have to be pretty selective on that. And we've been commercial over the years with customers who have a track record with us, who are balanced. They trade fairly. In soft markets, they don't squeeze out the last ounce of blood out of you. And in hard markets, likewise, we don't squeeze out the last ounce of blood with them. So these relationships are very important. I think probably over 80% of our customers we've been trading with for decades. So you have bad years, you have good years, you make money, you lose money, you have big cats, you have claims disputes, you go through cycles. The only way you can do that over decades is and having a positive relationship if both parties kind of give and take. And so that's generally we'll be commercial with those who we have really good relationships with, and we don't think will take advantage of us.
How often is the relationship with the broker versus the carrier?
Versus the carrier, in lieu of the carrier? Or?
Well, yeah. I mean, is it, it's one thing, how much of the commercial decisions that you're weighing are because, you know what I'm saying?
Yeah, listen, I don't know how often, but not infrequently, something becomes pretty important to a broker, and, the brokers are really important to us.
Sure.
And so, I get the call, or someone else gets the call and saying, listen, you guys have declined this, and can you please, look at it again?
Sure.
It's really important to fill in the blank of who the broker is. And of course we will. And, a lot of times brokers will get great, or I can get you this term, or I can, whatever the case may be, they get something out of it, and then you go ahead and do it for the broker. So we've done.
Of course. So hey, in the beginning, I talked about that, you've lived in a bunch of different places, and obviously transatlantic is a global platform. What's the toughest thing about managing that?
We are. I guess we have 20, 25 offices around the world. We're in all the different regions that you would think we would be in to be a global reinsurer. But that started 40, 50 years ago.
Sure.
When we were an AIG company, we were able to piggyback on AIG and get all the licenses that we needed to get around the world. And back then, reinsurance was really lightly regulated, if at all. So it was easier to build that kind of network being an AIG company 40 years ago. So the biggest difference and the biggest challenge today is, I'm not going to say reinsurance is regulated as strongly as primary insurance, but we're giving it a race. It's getting tougher and tougher with the different regulatory regimes around the world. So if you have 20, 25 offices and you have different legal entities around the globe, seemingly every country wants you to park capital in their country if you're going to do business or have a legal entity in their company, and that becomes challenging. So managing the different regulatory regimes, managing the capital, that's probably the biggest challenge of a global platform. But what offsets that for us, at least, is we just have this terrific network of employees who've worked with our company for a long time, who have great local relationships. So the fact that they know the customers intimately, they speak the same language, they understand obviously the cultures and customs, they're able to locally work through issues and opportunities, that more than offsets the challenges we have. And that's really one of the biggest strengths of our company, I think.
Do you struggle with, if you have a company culture that you're looking to push, how varied does it need to be depending on the location you're in?
It's a great question. So there's some things about our culture you want to be consistent globally everywhere, right? Ethics and values and,
sure.
and those kind of things, and uncompromising on that. And then there's just different ways of looking at risk and different types of exposures that you have to adapt to around the country. So as an example, our most profitable casualty portfolio is without a doubt in Canada. We've had a team in Canada for 40 years. We have great customer relationships. We have great broker relationships. We have a nice book in Canada, and that casualty book is very profitable. It's well underwritten by our clients and by us. If I would put an American in Toronto to underwrite that book, they would probably blow up the book in a year, because they would apply their kind of American way of thinking about the litigiousness of casualty to that book, and they would probably decline everything. So that's, again, a benefit of having local people in our branch network making local decisions, and being responsible for those and accountable for those local decisions.
Do you how different is like the human resources approach, or is it
in terms of,
well, I mean, do you have to, I guess one of the things that everyone talks about now is hybrid work, so do you have to have a different, or do you have a different hybrid work strategy?
Yeah, we're still trying to figure out our hybrid work strategy, to be honest with you.
Understood.
Even in New York. But the way our company is organized is, first of all, we're not, for a global reinsurer of our scale, we're actually not that big of a company headcount on purpose. So we have maybe 650 people spread around the world. However, really two hubs, and that's in New York. Probably half our headcount is in New York. And then in London, another, 100 to 150 at any given time is in London. And so when you travel around the world and visit our Singapore office or Hong Kong or Tokyo or San Francisco or Chicago or whatever, these are smaller offices by design. So, the San Francisco office is maybe 10 people, probably less than that. And so on flex time, we'll have a company policy, but San Francisco can figure out what works for San Francisco, and Munich can figure out what works for Munich. We're not really dictating on these smaller offices how they run their offices, as long as they run their shop well. So.
Sure, cool. The changing topics, there's been an explosion of fronting carriers over the last few years, and with it, MGAs with new access to capital. Which products has this been most notable in? And then how do you think it all ends? You can do the first part.
This question's going to get me in trouble, Adam.
No, go ahead.
I mean, you use the word explosion. I think that's a perfect word for it. So let me think about how to answer this. So in terms of, and we're talking about the fronting part of our industry that supports mainly MGA programs. For over 20 years, there was just one fronting company in our industry of any substance, and that was State National. We all know that. They did a nice job. And then you're right, over the last few years, there's 20, 25 new fronting companies. And, the vast majority of this business is fronting MGA program business. So my concern is if the fronting companies are lightly capitalized, and they are, and they take very little risk, which is true by definition of a fronting company, And the MGAs don't really take insurance risk as a general principle. And they don't. They might have a slide on their commission or something, but they're not taking true insurance risk. You know, what capital is supporting this business? I mean, the business has grown, I don't know, 10, $15 billion by some estimates. So the industry that's supporting all this risk capital is my industry. It's the reinsurance community. And, you know, we played from this same exact playbook in the late 90s with Legion Insurance Company and Clarendon Insurance Company and some others. You, Adam, you might not have heard of these companies. You're too young, but all these companies went under. So,
Yeah.
you know, the pitch to the reinsurers was, listen, we're going to give you access to insurance business that you otherwise won't get. And I would say that the pitch is very similar, if not the same now. So I'm not saying that there are not high quality, successful MGAs with a track record of success.
Sure.
There certainly are. And I'm not saying that the program market as a whole is bad and it doesn't serve a positive role in the industry. It certainly does. But I would suggest, at least from our perspective, what we've seen is a large amount of this business is likely substandard and written at terms that will eventually kill off some of these MGAs and kill off some of these fronting companies and kill off some of these reinsurers. You know, this is not business being poached from Chubb and Travelers. This is
Right.
Again, I know I'm generalizing. I don't mean to generalize, but it's a lot of distressed business, you know, like trucking or commercial auto, lines of business that have shown incredible resistance to profit over the past 10 years. So, you know, with all apologies to my colleagues at running companies,
Profit, I like that.
right? I'm pretty bearish on that whole sector. And I think you ask how it ends. I think it ends in tears like it did in the late 90s, early 2000s. Not for all. There'll be success, but there'll be a lot of blood in the streets as well.
But how far away is it? I mean, do you think
you never know till it is?
Right.
There's what was the famous saying? I died very slowly and then all at once. You know, so you know, a lot of this is third party liability. A lot of this has tail exposure. If you look in the history, why these insurance companies went out of business was different reasons, but I would argue that the reinsurance community just simply stopped supporting them. They said, enough of this loss-making business. I'm going to start sending cancellation notices. And then just the crush between the claims, the cash flow crush between the claims and the lack of premium coming in, you know, put the nails in the coffin for a bunch of these fronting companies.
Sure.
And so, you know, how close it is, I don't know. I'm not smart enough to know that, but I do think ultimately there's a good portion of this sector that, despite what people say, is not healthy. And you know, you just can't underwrite around some of these exposures that are very, very problematic, that need a lot more capital behind it and a lot more clever underwriting behind it.
Sure. Well, last question, going full circle. What's different in reinsurance now versus 20 years ago?
Well, I guess the most basic thing is reinsurance used to be an industry, right? Now it's kind of a business. And what I mean by that is 25 years ago, there were probably 40 pretty much pure play reinsurers in the industry. I mean, how many pure play reinsurers are there now? You know, it's got to be single digit. It's probably almost single digit, right? So reinsurance, a lot of times, is a division of a larger insurance entity, and that's a big change. Now, does it matter, or why does that matter? I don't know. Perhaps it doesn't matter. However, again, if you look at history, insurance companies who run reinsurance companies don't often work well. And the inverse is also true. Reinsurance companies who try to run insurance companies have not done well. So it might be different now. I mean, I think the global scale required to have success in reinsurance, supports the merging of these different disciplines. But I guess my point would be is they are different disciplines. They're different businesses. They require different skills. And I would say that, companies that manage reinsurance companies significantly different than how they manage their insurance companies and allow for those differences, they'll be fine. So I just think the overall landscape has changed in reinsurance. It's become much more merged into insurance and financial services. That'd probably be the biggest thing over the last 20 years. And
then 20 years from now, how do you think it's different?
I think I'll be safely retired, Adam, and I have no idea. I have no idea. Listen, who knows? Hopefully we won't fall victim to some generative AI business platform, and no need for underwriters and actuaries and claims people and everything. I doubt that will happen. Listen, in the end, reinsurance, just like insurance, serves a really, really practical purpose to the world economy. And so, yeah, the forms might be different. We talk a lot about innovation, and I think the biggest innovation in reinsurance has been the use and forms of capital. It hasn't been on the technology side. Sure. So maybe that will continue to evolve somehow. But 20 years from now, I have no idea.
Awesome. Well, hey, Ken, really appreciate you taking the time, and thanks for joining.
All right. Great. Thanks, Adam.
Awesome. Thank you.
Bye.